Okay, so what are some factors that might affect the size of the DLOM? Okay, so one factor could be the existence of a put right. What is a put right? Okay, a put right is a contractual right that entitles the holder to sell the ownership interest to a particular party at some time under some specified circumstance or price. So it says that at some time this will happen. Okay, in other words, a put guarantees a market under a specified circumstance. Where do we most commonly see these? In ESOPs. Okay, a lot of times in ESOPs there are put rights. So that could affect. Another one is the pool of available buyers and the size of that pool. Okay, so when we're dealing with that, we're talking about potential buyers. Okay, it's the existence of a reasonable number of potential buyers, or even one strong or two strong potential buyers that could dampen the discount. Okay, the size of the interest is another thing that we deal with. Large blocks tend to have larger discounts for lack of marketability than smaller blocks do. Okay, there may be fewer potential buyers for a large block, and a large block transaction may be more difficult to finance. Okay, one may logically conclude that a larger ownership interest may have a higher value because of the possible elements of ownership and control, such as swing votes, a seat on the board of directors if they have one. Okay, but those are different discounts. Those fall under potentially your discount for lack of control. And this is where we have to be careful to A, not double dip, and B, not mix apples and oranges, because yes, the size of the interest is going to have a discount under lack of marketability, but there may also be one that's required or put in under lack of control. So if you're taking an increased discount either under your control discount or marketability for this issue, then maybe it's not going to be an issue you're going to use for the discount on the other side. Okay, a prospect of a public offering or sale of the business. This is important. An imminent public offering or sale of the business could decrease the discount for lack of marketability. I had a case a couple of years ago dealing actually with this same fact. It was a private company. They were looking to gift interest into their kids. So I go through the valuation. I start asking the questions of management. One thing I always do on every engagement, and I suggest or strongly suggest everybody does it, is Google the business. Just type in the business, see what's out there. You find a lot of information, good information, bad information. One of the questions I specifically asked the client is, has there been any sales or potential sales of the business? They said no. No to the sales, no to the potential sales. Okay? So I'm going through the valuation, I'm doing my research, and I stumble upon an article that was in Bloomberg. So we're not talking about a no-name publication. We're talking about a prominent, economic financial publication that talked about a potential sale of this business that was virtually on the 25th hour. They were on the steps about to sign the deal, and then for some reason they didn't mention, it fell through. So they probably couldn't come to terms on some minor thing within the deal. The sale was for $500 million of this company. They had us believe in the company was going under. They were losing money, every other day, yada, yada, yada. Now, keep in mind that sale was a synergistic sale. The value was definitely higher than what it would be at a fair market value under a gift. But, they wanted us to believe that this business was lucky if it was worth 100 to 150 million. We have a sale for 500 million. That's a big gap. Is somebody really going to pay, a synergistic value of $350,000, $350,000? Probably not. And we needed to help them to understand this, that, while yes, our value isn't going to be 500,000, it's not going to be the 100 to 150 that they're hoping it's going to be. It just can't be. It's going to get attacked by the IRS, and we wouldn't be able to defend it. So that's very important. Now, while they weren't looking to go public, if you see any notes that they are looking to go public, that could decrease the discount, especially if they are very close to going public. So, it's important for us to do our due diligence. Accessibility and reliability of relevant information. So we kind of started hinting upon that before. When we're dealing with a public company, there's financial statements that are audited. They're put in front of the SEC. They're scrutinized. A private company, more likely than not, doesn't have an audited financial statement. Maybe they do, but most times we're dealing with tax returns or maybe a compiled financial statement. The information is less reliable, or potentially could be less reliable. We have to go in, thinking skeptically to some extent that, the business owner's best interest is to pay the least amount in taxes. So what are they going to do? They're going to put expenses through that, while maybe for tax purposes are okay, for value of a business coming down to fair market value, hypothetical buyer, hypothetical seller, what they may or may not put in their pocket at the end of the day as true cash flow may not be legitimate. So again, if we can't get into the detailed books and records, if we can't properly make the adjustments, then maybe there needs to be an increased discount, again, for the reliability. Are these numbers really accurate? Ultimately, at the end of the day, we need to think in the mind of the buyer. When you would go or when we're saying whether this discount's reasonable or not, that's what I mean, and you come to your concluded value. If you're going to invest in the business and you have $1 million, are you going to, and let's say you have two options. One, risk-free treasury bond that's going to give you 3%, or a startup high-tech IT company that's going to give you 3%. Where are you going to put your $1 million? In the risk-free treasury bonds. Why? Because your $1 million is guaranteed to be there unless the economy goes under, the country goes under, and you're going to get interest. Tomorrow, that high-tech business could go under. So you're going to expect a much higher return because you're taking more risk. The more risk, the greater reward, the more return. So in a more riskier business, it would only be reasonable to expect you would want to pay less to get a higher return. So you're going to have a higher discount for lack of marketability, which is going to lower that value. You're going to buy in at a lower amount. And when the company makes it big, you get your payday when you go to sell it. So that's the type of things we need to think about and consider when we're doing this.